Hey YouTube, hey YouTube, it's me. So, I know that a lot of people might be panicking if you invested in Shopify and Celestica because both companies are both stocks have been falling in price, and so as you can see, BTO is still the same, so BTO hasn't changed very much, but CLS, so I bought it for 35 and right now it's at 31. So so what I did is so I sold the call options for 310, and right now they're worth 30. So what I did is I put in an order to buy back my CLS call options for $30, the 35 strike price ones for $30 each, and then I'll sell the $32 strike price ones for like $560. So basically what's gonna happen is I'll pay $30 each to buy back my call options that I sold, and then the 35 strike call options, and then I'm gonna sell the $32 call options for like $500 each. So that is, so I already put in the orders, so that's what's gonna happen tomorrow when the market opens. So yeah, the price of the stock went down, but it also means that the call option price went down, so I could buy it back and then sell a more expensive one. So all the money, I should be able to make it back. There's no real risk if the stock falls in price, because I can buy back the call option for a significantly reduced price, and then sell a much higher value call option for the current strike price. So essentially it's hedged. If the price of the stock goes down, as long as I'm doing covered calls, it's hedged, because I can buy back the calls that I sold for a much lower price and then sell the current strike price ones for a much higher price. So the same thing for Shopify. So the stock price dropped from 70 to 64. So that looks really bad, but the call option price also dropped. It dropped from 420 to 130. So what I did is, what I'm going to do is I'm going to buy back the $130 ones, and then I'm going to sell some $500 ones for the current strike price, which is 64. So yeah, that's what's gonna happen. And then I sold another one. That one's at 71. So right now, I sold it for 370. Right now it's at 200. So I'll buy it back and then sell another 63 strike for 560. So as long as the stock price keeps going down, I can keep doing this. So I can buy it back for lower than I sold it for, and then after I buy it back, I can sell more at the current strike price for much higher. So there's essentially essentially no risk if the strike price keeps if the stock price keeps falling. Then I'll just buy back the call options that I sold for a lower price, and then sell the call options for the current stock price. So then in total I should be able to make back all the money that that I'm down from the drop in the stock price, because if I sell these and buy them back, I should make back 2,000, and then if I sell these and buy them back, I should make 800 plus 300 is 1,100. So I should be able to make back 3,100. So I thought very quickly about this. I was like, well, so first I realized the stock price went down, well, but then I realized, well, the call option price also went down, so I can buy it back and then sell some more for a higher price. So that's exactly what I'm gonna do. So that is the benefit of doing covered calls versus versus owning a stock, naked, meaning just owning the stock without having covered calls. If the stock goes down, then then you have, then whatever, however much the stock goes down, that's how much money you're down. But if you sold call options, then you can buy them back for a much lower price and then sell call options at the current strike price. So it's very much hedged. The risk is reduced basically to zero, or there's basically guaranteed profit, as far as I can tell, because if the stock price goes down, then I sold the call options, so I make profit from the call options and from the capital appreciation. If the stock price goes down, then the call option price also goes down, so I can buy back the call option for lower than I sold it for, and then sell more call options for more than I bought back. So yeah, it's as far the covered call strategy, as far as I can think of, it has no risk, because no matter if the stock price goes up or down, you're covered. So I'm going to keep doing this because it's very good. I love it. So I'll show you my balance sheet for today, but obviously I'm going to make all the money back. So before the long calls that I bought, so they're still down 300. Cover calls are fixed, but I'm going to buy them back. So it's just so I'll do all of that accounting tomorrow after the market closes. And right now my balance sheet looks really bad. So yesterday it was at 39,000. Today is at 37,000. So looks very bad on paper, but I know as soon as market opens tomorrow, I can sell all 7 of my call options and then buy them back for a net profit of about 3,000. So I should be back up to about 40,000. Because yeah, I already have all of the buy and sell, the sell and buy orders. So buy back and then sell again, buy back and then sell again, buy back and sell again. So there shouldn't be any issue. So yeah, the more I think about the covered call strategy, it is absolutely brilliant. Regardless of whether the stock goes up or down in price, it is good. It is absolutely brilliant. So that is about everything. So I'm going to I don't know, maybe I'll talk about a bit about the market. So whether or not, so I already said it doesn't matter if the stock goes up or down in price. I will make money regardless of what direction the stock goes. regardless of what direction the stock goes. But let's see. So I don't know. I think one thing is that the volatility is much lower. Now for some reason. It used to be at above 80%, but now it's at 40. So I'm not sure. And then for Shopify, the volatility is still good for Shopify. Yeah, volatility is still good for Shopify. But for Celestica, the volatility is much lower than it was before. I'm not sure why. So obviously this isn't gonna happen anytime soon, but if Shopify or Celestica go above the price that I bought them for, I may sell them back and then buy different stocks, depending on how the volatility changes. Volatility of these stocks change and the volatility of the other stocks. Because for example, CNQ looks okay. Well, right now the volatility is still pretty low, but if the volatility goes higher, then I might sell one of the stocks I own and then buy CNQ. But anyway, so the main point of the covered call is it's essentially an insurance, so that if the price goes down, then you're covered. That's why it's called a covered call. If the price of the stock goes down, then you're covered, because you can buy back and then sell again and make back the money from the capital depreciation. If the stock goes up, then it's good, because then you're holding a more expensive stock. So no matter which direction the market goes, you're covered. As long as the stock price doesn't drop too quickly. So like the drop in the stock price has to be proportional to the volatility. So if a stock has a very low volatility, so the call option isn't worth very much, and then the stock suddenly drops a lot in value, then you can't make your money back from buying back the call option and selling again. So that is why, everything being equal, it's better to buy a stock. The higher the volatility of the stock, the safer it is to do the covered call strategy, because the price of the call option is a very high percentage of the price of the stock itself. So if there's any change in the price of the stock, you're covered by buying and selling the call options. That's essentially the idea. Essentially it's the same as doing long calls, so buying call options, but in reverse. Basically I'm shorting shorting call options, because I sell them and then buy them back for a lower price. So yeah, if the stock goes down, I don't have to short the stock, I could short the call option, which is essentially what I'm doing now. I'm holding the stock because I know that in the long term it will go up, but in the time being I can keep shorting the call option by selling it for a high price and then buying it back for a lower price. So yeah, everything is going to be just fine. So this is I think as long as you're doing covered calls and you understand how call options work, how stocks work, you should be fine. You shouldn't lose very much money. Like in theory, if the volatility is high enough, it should be impossible to lose money. So yeah, so the key thing is to pick stocks with extremely high volatility, which in the long run will go up. So you can keep holding the stock, and if the stock is going down, then you just short the call option. So let's just look at the TSX index in general, so how the Canadian economy is doing. So it hasn't changed very much. It's I think it's down like 4% it's down 8% in the past 6 months, which is not enough to qualify as a recession or a bear market. So it's going down, but it's going down very slowly. It went down 0.38%, not a significant change. So if the volatility, so the one thing is that if the volatility of CLS is down, let's see, I think the volatility is still okay, especially for December. Well, no. Yeah, the volatility for CLS, for some reason, it went from 80 or 90% down to 50%. So if CLS does go up higher than I bought it for, I may sell it and then see if there's another stock with a high volatility, which has a long-term trend of going up. So that is something that I might do, but I think in the short term CLS is probably going to keep going down, so I'll keep shorting the call option. Let's see if there's anything else I have to say. So that for the long calls, so they're still they're all still down because the market is going down in general. So in general, I think the price of every stock is going down. So on average, call options are going down, which is fine because I can short the call option. So the thing is, if you were selling put options, then you would be in trouble. Well, maybe. Well, I don't know. The thing is with the TD web broker, because I'm using TD, you're not allowed to sell put options. Well, you're not allowed to sell cash secured puts. So if you sell a put option, you have to be short in the stock. So if I wanted to sell a put option, I have to have minus 100 shares of the stock. I can't sell a put option if I have the cash to back it. So for whatever reason, TD doesn't allow that. I don't know why. So even if because I tried doing cash secured puts, because it may or may not be safer because I don't have to own the underlying stock. But because I'm not allowed to do this with my bank, then there's no point really discussing it. So anyways, but the thing is with the covered call, yeah, no matter which way the market goes, if it goes up, if it goes down, you're covered. I think that is the meaning of a covered call, is that no matter which direction the market goes, you're covered. So I think I will end the video here, and then in the description I'll put a bunch of links into sort of an explanation of the covered call strategy. So basically you have to own at least 100 shares of the stock, because that is called one lot. So per one lot of stock you can sell one call option. And then and that's essentially it. So as long as you hold the stock, then you can sell a call option after the option expires, and you can sell another call option, and you can keep doing this forever. It's basically like if you own a house or an apartment, and then the price of the house could go up or down. So that's the price of the house could go up or down. But regardless of that, you can rent out the house, every month, and then you get a rent payment from your tenants. So that's essentially the idea of selling covered calls. Is like renting out your stock to other people. But the one difference is that, for example, if your house price goes down and then the rental value of your house is lower, then you can't, for example, you can't short the rent. You can't, say that the rent used to be $900 a month, but now it's $300. So I'm gonna buy back the rent contract from my tenant for $300, and then sell a different rent contract for $900. So that's how it differs from the housing market. Is that it? I think it's safer. It's safer because you could, if your house price goes down, then you can short the rent contract. You can buy back your rent contract for a lower price and then sell another rent contract. So that's something that you can't do with houses or real estate, but you can do with stock, because you can own negative shares of stock and negative numbers of option contracts. So yeah, if there's more, then I'll explain it in my next video.